Good morning from London. I'm Anna Edwards alongside Kriti, Gupta and Valerie Tytel. We're an hour away from the opening trade. Here's what you need to know. Donald Trump fires off his first wave of tariff letters, including levies on key allies and trading partners, but suggests he's open to additional talks before the revised August 1st deadline. Meanwhile, the EU hopes to reach a preliminary deal with the US this week that includes a 10% tariff and some exemptions for key products. Plus, Washington promises more weapons to Ukraine. The American president signals the reversal as he issues a rebuke of his Russian counterpart.
Let's check in on these markets to start the hour. We are seeing a move of stabilization, Anna. We're seeing it in S&P futures and in Eurostoxx 50 futures, also in the dollar. We're really rebounding from dollar strength yesterday. Euro seeing some gains. Those 10-year yields are holding in steady this morning. There has been a rise in JGB yields, so there is some pressure lower on fixed income generally this morning. The countdown to the opening trade starts right now.
I would say firm, but not 100% firm. If they call up and they say, would like to do something a different way, we're going to be open to that. But essentially, that's the way it is right now.
Firm, but not 100% firm. Those are the words from Donald Trump as he issues letters across the world, from Japan, South Korea to right here in Europe. We got to dive into the details, though. The market's not blinking. What's actually in these trade deals? Let's start with the Asian story, Anna.
Yeah, absolutely. Let's recap where we've been. And that's clip from President Trump really crucial in telling us something about the way the market is responding here. Because, as you say, the market's quite relaxed, really, about what we're hearing around tariffs. And part of that has to do with the new August 1st deadline and the fact that the president said, yeah, it's firm, but it's not really that firm. We're open to talks, open to negotiations. I mean, we say new deadline of August 1st, but if anyone was listening on Friday, they'd have heard us talk about how this gives another 3 weeks for negotiations. So that kind of was out there, but it seems as if the market is catching up with that kind of thinking. Interesting that South Korea has been saying they want the sectoral conversation to be part of what happens here between now and August 1st with the United States. Japan putting a brave face on things and saying, look, we're still talking, getting a better relationship with the US, that they are making progress, they say. But in terms of the rates we've heard about, if nothing happened from here, August 1st, we see 25% on Japan and South Korea and a host of higher rates on Indonesia, Thailand, Cambodia, Bangladesh, Malaysia, and the RBA with a surprise hold-in policy because of all the global uncertainty that we have out there.
Yeah, I know you were just talking about the new tariff rates. They do align really quite closely to what was announced on April 2nd. But what they don't align with is that threatened higher bracket that Trump talked about on Friday when he floated 60 to 70%. We thought maybe those would be on some of these Southeast Asian economies that did have the higher bucket of tariffs announced on April 2nd. So maybe some reprieve for the markets. We have seen Asia stocks trade pretty well overnight on the back.
The key takeaway here seems to be this 180 that Donald Trump is doing with various countries. Japan was supposed to be someone that he was very friendly with, that you did start to see foreign direct investment from Japan, and the likes of Nippon Steel, for example, actually getting the green light. That was a friendly conversation between these two countries. To now see this go to the potential threat of 70%, as Val mentioned, but also now even hitting 25%. To your point, Anna, that brings the sectoral tariffs of the chip story very front and center when it comes to the likes of South Korea, for example, because if you can evade the country tariffs, maybe Washington will get you on the sectoral basis.
Yes, and worth noting the people we haven't heard from yet. We don't know about India, for example, and President Trump has talked in the past about how progress is being made there. And crucially, Valerie, we haven't heard what happens with Europe. And, you know, Europe still is working towards a deadline that is the end of today, beginning of tomorrow, US time. July 9th still applies in the European case.
Yeah, we are hearing reports that this EU-US trade framework is inching closer to a deal. You know, we're seeing the reaction in the euro this morning, trading 0.2% higher, rebounding up from it yesterday. We have heard reports from Politico that the U.S. has offered the EU a 10% deal with some caveats. That hasn't been finalized, but they're talking about some key exemptions for sectors such as aircraft, such as wine and spirits. We know that the EU in the past has called for these exemptions, and it sounds like they're close to an agreement on that. It hasn't sounded like they're close to an agreement on things like cars and pharmaceuticals, so there might be some key sticking points there. But we did hear from the EU trade chief yesterday saying he was not expecting to receive one of these letters. Chimes with what Reuters was reporting late yesterday as well. So maybe the market is going to take from that there is still a runway of 3 weeks for these negotiations, you know, all the way up to August 1st. That is the kind of timeline that they have, though the EU does want to get a deal sooner rather than later.
A complete turnaround from what the EU has been offering. They went from 0 for 0 to, okay, we'll take 10. Okay, we'll take 10 with caveats. And I think this is a key piece of the UK trade deal as well, and this idea that not just in the Trump administration, but a key pillar of that trade relationship between the UK and the US has been these carve-outs, has been the defense carve-outs, has been agricultural carve-outs, et cetera. Do you take that framework and apply to Switzerland with pharmaceuticals, the EU with steel, et cetera?
Yes, and you point out on this graphic here, Kriti, the role that pharmaceuticals plays in the relationship, the trading relationship between Europe, and this is Europe into the United States. So whether President Trump will really want to take on that industry, although we should say we haven't heard about the sectorial tariffs on pharmaceuticals or others. There's lots of these sectional investigations going on, but we haven't heard about rates, and that might or might not be separate. We might hear more about quotas when it comes to the European thing. Getting these exemptions maybe will involve allowing some quotas of tariff-free trade in certain sectors. Non-tariff barriers, we should certainly be alert to that as well. Digital services tax, for example. We know how much that has frustrated the U.S. administration.
Yeah, but a 10% number does sound like a good outcome for the EU, and the last number that Trump had floated was 50%. The April 2nd level for the EU was 20%. It does sound like the EU could be getting one of the better deals that's been announced.
And they've got a couple
recently.
of buckets of potential retaliation if they want them, but if they think 10 is good, do they just leave those by the wayside? Because they earmarked 21 billion euros, then a further 95 billion euros worth of product that they could target.
I'm old enough to remember 3 months ago when even 10% was a shock for the markets and it was a shock for corporations around the world. As we dive through some of these tariff negotiations on both sides of the Atlantic and Pacific, I might add, let's talk about the geopolitics that are also kind of looming in the background as well. Taking of a 180 on the tariff front, there's also been a 180 when it comes to the geopolitics and Donald Trump's relationship with Ukraine and Russia as well. I think this is really crucial here because we know in the last couple of days, Anna, you had flagged this last week, that the Pentagon was stopping sending excess or additional weaponry, I should say, to Ukraine. It looks like Donald Trump turning that around. He had a phone call with Vladimir Zelensky on Friday and now actually talking about giving defensive equipment, not offensive. We're not talking about missiles here, which is something that the Biden administration had given, but saying that he's very disappointed with Vladimir Putin and ultimately is still providing that defensive capability to Ukraine.
Yeah, and if it matters in the moment, and I'm not sure, there's a lot of reporting around where this came from, this initial pause. Certainly the White House spokeswoman saying that Pete Hegseth had ordered a review when he took office, and there's all kinds of reporting about how much Trump was part of that or not. We'll wait to see. No doubt this will all come out in the wash. But it does suggest something of a pivot in US policy, doesn't it? Away from pausing, away from lukewarm support to being more critical of President Putin. But I feel as if we might have been around that loop before.
Yeah, and this comes at the same time that Netanyahu was in the White House yesterday. We also had reporting overnight that Chinese firms have supplied Russia with war drones. So maybe there's a situation getting a bit more complicated, maybe pushing Trump to supply extra defense equipment, as you mentioned.
Yeah, and I think it's a crucial time as well. I was just a kind of fun fact to the story is that as you start to see these defense stories ramp up around the world, not just the United States, but Canada as well, for example, they're having the same conversation that we had here in the UK last week, which is at the expense of your defense ramp up, what else gets cut? The fiscal story also looming as a consequence.
Absolutely. We certainly won't lose sight of that. Let's tell you what's coming up on the programme. And then in terms of the guest conversations we're going to be having, we will be joined by Paul Donovan, UBS Global Wealth Management Chief Economist. Jeffrey Yu will be with us, BNY Senior EMEA Market Strategist. We'll talk to both of them about the latest tariff news lines, what they mean for their assessment of the global economy and the outlook for investment strategy. We'll also, with that in mind, speak to Benedict Lowe, BNP Paribas Markets 360 equity derivatives strategist. A lot to say there about volatility. Francisco Blanch, no stranger to volatility, Bank of America Global Research Head of Commodities. What does he make of? We've got a bit of a drop in oil prices, perhaps on the back of some of this tariff nervousness, but there's a whole lot of other stuff happening when it comes to oil prices, as we know. Arancha Gonzalez will be joining us as well, former Spanish foreign minister. Really important as we close in on a conversation and a framework, hopefully, perhaps, between Europe and the United States. As we close in on that, really important to get the thoughts of those such as Arancha Gonzalez who've been at these tables, try and get an understanding of where the priorities will lie.
And let's take a look at what's coming up today on the docket. We are light when it comes to economic data today, but still a few key things to keep an eye on. We do have the French President Emmanuel Macron, his first state visit to the UK. We know that maybe defense and the migrant issue might be on the table for discussions. We also have the EU economic and finance ministers meeting in Brussels. And later today, it's Amazon's Prime Day. The annual sales event begins today through July 11th for maybe some hints on how U.S. consumer demand is shaping up.
I have so many thoughts on Amazon Prime Day. I'm always overwhelmed by the deals, but I think the focus maybe today is more on Emmanuel Macron's visit to the UK.
Yeah, absolutely. I mean, that's certainly going to be a focus. Really serious subjects on the agenda, of course. Defence will no doubt be one of them. We've seen some really interesting reporting about the extent to which Europe is going to allow Canada and the UK into being eligible for some of those defence deals. Migration will, of course, still be on the agenda. And we haven't seen a French president visit the United Kingdom since, I think, 2008.
2008.
Yeah.
Long time coming.
Yeah,
right?
absolutely.
But yeah, Keir Starmer hailed this as a historic visit, and Macron is due to address Parliament later today as well.
I wonder what he has to say. I wonder if we
hopefully no tears.
I hope. Let's make sure Emmanuel Macron is in fine firm. Let's talk about what else we need to know this morning. Plenty to digest around the world. President Trump says he will travel to Texas on Friday to see the devastation from flash floods, which killed at least 100 people and left scores still missing. The deaths include at least 27 children and staff from a summer camp. Recovery teams expect to find more victims as the search continues. And officials are facing questions over their response, including a lack of warning sirens in an area prone to flash flooding. And Bloomberg has learned that Blackstone is considering a joint bid for French telecom operator SFR valued at up to 30 billion euros, including their debt. Blackstone has been in early discussions with other potential suitors, including SFR competitors. CEO Steve Schwarzman said in June that his firm is planning to invest as much as $500 billion in Europe over the next 10 years. And Samsung's profit has fallen for the first time since 2023. The company reported a sharper than anticipated 56% drop in operating income for the June quarter. Performance was hurt by U.S. curbs on China-bound AI chips and delays in selling cutting-edge memory to NVIDIA.
Coming up on the programme, then, one of London's biggest asset managers could be facing a defining moment. Today's big take is on the historic city firm Schroders. Plus, Samsung's earnings report could spark concern in the sector. We'll check on the European chip makers at the open. Up next, trade dominates headlines and markets. We'll discuss that next. If you have questions, if you want to get involved in any of these conversations around this desk, IB plus BBTV Go is the function on the Bloomberg terminal. This is Bloomberg.
We will avoid easy compromises. We have been working hard to insist on what we need and to protect what we need to protect. We will continue talks with the U.S., protecting our national interests while actively seeking the possibility of a deal and benefits for both the U.S. and Japan.
Prime Minister Shiba speaking after Japan received notice of the U.S. plan to impose 25% tariffs on its good. A complete turnaround when we talk about the relationship between the United States and Japan, one that was, for all measures, going fairly well until this tariff rate. We'll see how that goes. It comes under a broader swath of letters, again, threatening key trading partners with high tariff rates, even as he delayed the increased duties until August 1st and suggested he was still open to negotiations. Let's talk about how all this applies to Europe and specifically the deal between the United States and the EU. We're joined by Katerina Roskopf over in Brussels. Katerina, thank you for joining us this morning. Just walk us through where things stand here between these two relationships. We went from 0 for 0 to potentially accepting 10% of a flatline rate. Where do we go from here?
Yeah, good morning from Brussels, where the European finance ministers are going to meet today, and trade will be a big thing to be discussed by them as well. The EU did not get a letter yesterday other than Japan, South Korea or South Africa, so there's still hope for a trade deal and negotiations are going on hot. Maroš Šefčovič, the EU's chief trade negotiator, is trying to home in on 10%, probably with exemptions for some key industries such as aircraft and wine. And potentially, from what we hear, the two sides are also discussing a so-called offset mechanism that would allow companies to make automobiles in the US to export a certain number of them for free.
Thanks to Katerina Roskopf in Brussels. Let's now turn to the Asia story and bring in Bloomberg's Paul Jackson in Tokyo. Paul, what's been the response from Asian nations on this latest round of tariffs?
Well, I think while there has been frustration that these tariff levels, some of them have gone up, I think there's also an element of relief. If you look at Japan, Donald Trump was threatening up to 35% as recently as last week. So to come away with 25%, even though it's actually slightly higher than the amount mentioned in April, I think there's an element of relief that Trump hasn't come in harder. For the South Koreans, I think they'd expected an extension, which now kind of applies to everyone. They've had 6 months of political turmoil, so very difficult to reach a deal when a new president has only just come in last month. So looking forward, on the Japan side, we have an election for Ishiba. He's got to get through that and make sure he's got a government that he can shore up and then continue with negotiations after that as we get to this August the 1st deadline. Likewise for the Koreans, more negotiations to go. For the Japanese, it's the car tariffs that's the key thing. These are sectoral tariffs. They're separate from the reciprocal tariffs, but they want everything done all in one deal. For South Korea, again, cars, chips are also an issue, along with aluminum and the steel. And also the US has raised issues with restrictions on the digital sector that are affecting major US tech firms. So they're wanting some of the regulations lifted there. So there are some of the concessions that may need to be made going forward.
OK, Paul, thank you very much. We're both Paul Jackson with the latest on the Asian response to President Trump's tariffs. Some more on markets as investors weigh a possible extension to Trump's tariff deadline. Then we're joined by Paul Donovan, chief economist at UBS Global Wealth Management, and Jeffrey Yu, senior macro strategist at BNY Mellon. Thank you both for joining us with all of the answers, no doubt, about where things go from here. So just to reiterate, the US has then announced that universal tariffs that were due to kick in on July 9th would be delayed until at least the beginning of August, which was a sort of more macro, bigger picture statement than perhaps I appreciated first thing this morning. So this is kicking out the deadline even for those who didn't get letters. Paul, how are you viewing the latest here? Are you preoccupied with downside risks to growth from tariffs and the US consumer? Or are you saying to yourself, well, some of these tariff rates being talked about, they're not as high as they could have been? What are you thinking?
Well, I think we've got to be careful saying, oh, it's only 10%. This is the largest tax increase the US consumer has faced in over 70 years. I mean, this is a big tax burden being placed on the US consumer. Kicking the deadline out to the 1st of August, though, does mean that with the new tariffs, so the incremental increases, they probably won't show up in consumers' shopping baskets until after Christmas. Because by the time you've got the goods shipped to the United States, you've got through the supply chain, given that a lot of retailers obviously order early for Christmas, they stock up for Christmas. All of that means that this hit is probably pushed out into next year. Okay. And that's obviously something which is going to lessen some of the damage to US consumers in the second half of this year, though the existing 10% tariff is going to start showing up in their wallets probably in July, August consumer price inflation.
OK, so Jeffrey, so it is a big deal. Even 10% is a big deal. But perhaps this is going to take longer to show up in the data. I mean, Chair Powell's been talking about looking for this in the summer. But maybe we all need to be looking for this, as Paul says, much later.
And then taking a step back in the context of financial conditions, there's just more uncertainty. Uncertainty actually does contribute to some tightening financial conditions. But admittedly, I think over the last, 2 or 3 trading days, more of the focus has been on Fed expectations, the reaction after the payrolls number. But I think this, as Paul mentioned, will feature into the Fed's inflation thinking further down the line and may delay some decisions as well. So we'll see.
Talk to us about those delays, though. There was a question that when Liberation Day first happened, this kind of uncertainty, this volatility would show up in these markets. We haven't seen that. Is there a complacency to this market, or is this a sign of resilience? How would you interpret it?
So I think there are two sides to that. One is if you look at the drivers of the market, especially the US equity market and European equity markets, these are domestic themes at the end of the day. What's been driving European holdings, if you look at our data, aerospace and defense, but that's a domestic story. If you look at US tech, that's a domestic, it's a long-term secular capex story as well. So I guess, there's this willingness to separate trade-related factors driving markets, versus the non-trade-related factors driving markets. But ultimately, I would say the headline grabbers, are the domestic side of things. But I think the trade side will need to catch up at some point. Maybe the answer somewhere in between.
Paul, let's dive into that domestic side that Jeff was just talking about. There's a question here that, or at least the math from the White House administration, or the Trump administration at the White House, I'm going to get my words right here, is simply that the tariff revenue offsets trillions in tax cuts over the next 10 years. It's a question of whether that math actually shows up. But then in the meantime, the end American consumer is still fine. Household income is still fine. Wages are still rising. Is the tariff impact smaller, perhaps, on the end consumer than we thought?
No, I don't think it is, because what we've got to recognise is that the tariff doesn't hit the consumer immediately. On average, there's a 92-day inventory period between getting the goods arriving at the dock and then on the shelves in Walmart or Target or wherever. So we wouldn't expect the consumer to be feeling much of the pain now. That comes through later. Now, I think there is occasionally a misunderstanding because, of course, tariffs are applied at the point of entry. So if you're talking about a finished consumer good, a 10% tariff will raise the price of that good to the consumer by 4 percentage points because the tariff doesn't apply to the retailer's costs or the wholesale or the transport costs or the advertising and all of those other costs that come after the point of import. So that pass-through is less. But the consumer is going to feel this, and that is going to be important because by the end of this year, real inflation-adjusted wages are going to be going down, not up. And that's when we're going to start to see some of the problems really kicking in. The pattern is, first you get the inflation, consumers use credit cards and savings to tide themselves over. When that's exhausted, then the negative real income starts to kick in, and you get the reduction in consumer spending coming from that.
Paul, what kind of gap between those two points in time is there? So you were mentioning at first the consumer pays up, pays the higher inflation, but then eventually it eats into their wallet so much that demand is impacted. What kind of timescales between those two moments? It's got to be pivotal for the Fed.
So that's a tricky question. Economists are always going to evade the answer if they can. And it's a tricky question because, in part, it's going to depend on job confidence. Now, we're not seeing a lot of firing going on, but we've certainly seen hiring pauses going on because of all the uncertainty, the erratic nature of the policy. The other thing it depends on is how bad does the inflation get, because the direct effect of tariffs on inflation, that's quite easy to calculate. The indirect effects, what happens? Do US manufacturers raise their prices because they can? Do we get profit-led inflation where retailers say, well, everyone's expecting price increases, let's give them price increases? And we're seeing some of that already. If you look at some of the areas where tariffs are already biting, I did a blog going into detail on banana prices, which is absolutely fascinating as a subject. Banana prices, even with tariffs, should be going down in the States, but they're rising by 7% because everyone's expecting prices to go up because of tariffs, and so the retailer has exploited that and added to the profit margin. The more inflation you get, the quicker you eat away at the spending power and the quicker the problem on demand comes through.
There's so much more that we have to unpack, so we're going to keep you both. Don't go anywhere. Paul Donovan, Jeff, you are staying with us. In the meantime, I want to leave you with a little bit of sound here. As the world comes to terms with the new U.S. levies, the BRICS countries are in Rio discussing a possible response. I want to leave you with thoughts of Brazil's president, Lula da Silva, from the summit.
Presidente da República de país do tamanho dos Estados Unidos.
A president of a country the size of the United States to go around threatening the world on the internet. It is not right. He needs to understand that the world has changed. No, we don't want an emperor. We are sovereign nations. If he thinks he can impose tariffs on countries, countries also have the right to do the same.
Welcome back. This is the opening trade. It is Tuesday, the 8th of July. We have had news, of course, since European equity markets were last trading and the open, which comes in around half an hour's time. We have had news, of course, from President Trump sending out letters, naming tariff rates for certain trading partners and moving the tariff deadline out to August the 1st for seemingly everybody. So where has that left risk appetite? Well, European stocks look a little range-bound right now, perhaps waiting for further news around Europe. That would seem to be an obvious conclusion to come to. US futures are pointing a little bit higher. Asian markets have been actually really quite resilient through the overnight session, up by 0.3% on MSCI Asia Pacific, as the market, Kriti, has focused more and more on the fact that the deadline has extended rather than the rates that have been imposed.
It's fascinating.
Or not imposed yet.
Well, no, it's a fascinating one because kind of virtually unchanged on the futures picture, virtually unchanged in the bonds picture as well. And I think this is interesting. Only higher by maybe 1 basis point across the European curve. Similar story over in the States. You're looking at a 10-year 4.39, only higher by 1 basis point this morning. Valerie, rescue us. What should the markets be paying attention to?
Right. Where is the drama? I compared yesterday's price action to what happened on April 2nd. And there's a few key things I want to point out. Yes, in both instances, equities were lower. The S&P ended the day in the red. But it was very interesting to see the price action around the U.S. dollar. On April 3rd, the U.S. dollar really kicked off a bout of weakness that lasted for weeks. Yesterday, the U.S. dollar was actually stronger. Is this really a regime change now in the U.S. dollar? It used to weaken on the back of bad news about trade, but yesterday we didn't see that. If you flip on, we can actually check out how markets are stabilizing this morning. We are seeing a slight bit of dollar weakness, U.S. equities rebounding, those 10-year Treasury yields, treading water slightly. But let's compare what was announced yesterday to what was announced on April 2nd, because many of them were banging online between the April 2nd date and the new rate. You had Japan, South Korea around the same lines. Thailand standing out as one of those high rates, 36%. That did hit some U.S. retailers yesterday who have heavy reliance on Thailand for their manufacturing. Nike, Lululemon, Gap all softened in after-hours trade yesterday off the back of these tariff announcements.
All right, Valerie Tytel walking us through some of the things we need to be keeping attention on as we parse through all of the data and all these trade agreements that may be coming down the pike. Let's get a little bit more into that. We bring back our all-star panel this morning. Paul Donovan, chief economist over at UBS Global Wealth Management, and Jeffrey Yu, senior macro strategist at BNY Mellon. Paul, I'm going to come to you first because before the commercial break, we were talking about bananas, which was very exciting. But talk to us a little bit about this kind of shift in potential supply chains. We've been talking about this in the first Trump administration, even post-COVID as well. How evident is that in the data? Are we seeing that perhaps circumvent some of the potential pricing risks?
So there's two shifts that are going on. So the first is bringing production back to the United States. Now, this won't create manufacturing jobs. If the US starts increasing manufacturing jobs, that's a sign it's in economic decline because you're not supposed to be creating manufacturing jobs, but automated factories. And that was something that was really happening from 2021 to 2024. And now it's stopped, because the uncertainty about supply chains, about what's going on with policy, means that I think a lot of companies are perhaps reluctant to commit to building new factories. But we had seen record factory building over the last 3-4 years. And I do think over time we will see this localization where producing close to your customer base, you're effectively doing robot for people substitution, but you're putting robots in New York substituting for people in Shenzhen or wherever. That, I think, will continue. In terms of rerouting supply chains, this, of course, is what happened after President Trump's first term, tariffs. China, in particular, just reroutes dramatic numbers of ships. You get the products going through other countries. That's something the administration is trying to tackle this time. I think it will be fairly ineffective in that. It was very ineffective in the first term. You find a way of avoiding the tariffs just by, sending the goods to Canada, slap a maple leaf on the side of the box, and there you go.
Do you trade that, Jeff? Do you trade the slapping of a maple leaf across the box? I ask this in the context of when we talk about this friendshoring argument, I'm trying to figure out if the FX market and the terms of trade actually react to the idea that maybe you can have supply chains extend from U.S. and China to U.S. Mexico to U.S. Colombia, if that's something that is actively tradable in this market?
Well, put it this way: looking at our data right now, what our clients are what our clients are reacting to right now probably is not the case. I mean, I would actually have expected, for example, in Latin America, there may be greater demand, for the bond markets, good real yields right now. Starting to see some of that, but nothing out of the ordinary. Whereas we're just talking about Australia, earlier, and maybe some of these AAA names, very well rated. Have they been benefiting, from this theme of moving away from the US and greater regionalisation? Not really. So I think all these themes put together related to trade. It's something actually more talked about than actioned upon right now.
Jeff, what did you make of the price action in the U.S. dollar yesterday? I was really astounded that it kept its strength and it didn't decline off the back of these, frankly, increased tariff rates, the shock and awe that Trump announced yesterday. What do you think of that?
So it shows that correlations are still in flux right now. And also now, compared to April, the dollar has weakened significantly. I think the other element is the payrolls number last Thursday, that July cut, by the Fed's been priced out. So there's some more resilience in terms of interest rates and nominal and real rates as well. So quite a few moving parts, but just going back to the numbers, there isn't really any marginal change in the news. I mean, if there are just massive multiples of the tariffs announced compared to April, then maybe a shift back. But I think the market's just not seeing as new news. They're happy with the valuations right now.
But do you think that maybe the dollar decline has found a level of stabilization here? I mean, we've all been waiting about, what will make the dollar turn around. I think yesterday was a clear signal that maybe, more losses for the U.S. dollar might be hard to come by.
I agree. Eurodollar has topped out, right? I'm actually seeing Eurodollar, quite a few big figures lower towards the end of the year. You're seeing, like yesterday, there were some ECB members, just outright thinking, that cuts are needed. I think valuations are going to be a bit painful up ahead. But say dollar versus APAC currencies, these heavily funded savers, Swiss franc, for example, I still think some dollar weakness. So on a trade-weighted basis, I think dollar will marginally weaken, but you just got to pick against which currency. It's not going to be broad-based weakness.
Paul, Jeff just mentioned the RBA in passing there, and we've heard from them a surprise hold in policy. They were expected to cut interest rates and they didn't. And some of the reasoning is related to this conversation around tariffs. They're talking about how there's just a huge amount of uncertainty there. And I wonder how much then rest of world should be nervous about what a lot of Chinese product in the market does to inflation rates. Are we still going to be talking about that? So we might be talking about pass-through and higher inflation in the US at the margin, but what about the rest of the world?
Well, one of the interesting things is that we haven't seen a great deal of evidence of disinflation forces coming through in Europe, say, from the Chinese goods. And I think this has to be considered in the geopolitical context, that China wants to be seen as sort of the adult in the room when it comes to global trade. It's not necessarily going to rush down a dumping route. Now, I know the current French finance minister is going on about, well, we must protect, European industry, by which he means French industry. But no, I don't think we're going to be seeing that. I think this is going to be fairly restrained. And I think there is a very conscious effort from the rest of the world to say, OK, well, look, if the US wants to play at being, the hermit kingdom and mimicking North Korea's economic model, you go ahead. We are going to carry on trading in a civilized way with one another. We're not going to do dumping and try and avoid that. We're not going to put up artificial barriers against each other. This isn't the 1930s. This is unilateral action by the states, not a multilateral collapse of the global trading system.
OK, and I suppose that is interesting when we think about how other nations might retaliate here, Jeff, or how they might not, because we've already seen what happened to China when China retaliated and where that ended up. We are in a truce now, but we've also heard warnings from President Trump about what would happen if other countries retaliate. So do you think a lot of places in the rest of the world might try to, I don't know, do you call it, take the higher ground and just not retaliate?
Right, and I think another sense of directional travel, the direction of travel is actually try to focus on multilateral arrangements as well, within their own framework. Just look at the EU-China trade relationship, for example. So there are some tensions there, heading into the summit, but minimum pricing agreements from everything from brandy to EVs, for example. I think that could be a new mode up ahead, and try to allay different concerns. So I think each country right now, they're just trying to frame this new wave of trade agreements and multilateral framework and just try to make sure that things keep going. So I pretty much agree with Paul's sentiment there. But when push comes to shove, I think the countries will still try to look out for their own individual arrangements as well. Yeah.
Paul, I'm going to give you the final word here. There's a question specifically in Europe about whether the inflationary impulse from the United States bleeds into this region or goes in the opposite direction on the threat of Chinese overcapacity. What's a more likely scenario for Europe?
So I think Europe is on a disinflation path. This is it's a sales tax that's hitting the US consumer, and things like profit-led inflation are very localized. So this is a local US issue with regards to the inflation impulse and the potential risks. Because of the damage to US growth, this is a disinflation force to the rest of the world. We've already seen what's happening with commodity prices. So I would argue that the disinflation trends in Europe that were already in evidence are going to be continued by this sort of US action. Though, as a final point to think about, we have to assume that Trump will retreat because that's his modus operandi. So I think we've got to be a little bit cautious about saying, these are absolutely set 1st of August. These are the taxes that are going in on the US consumer. I think that as you start to hear cries of anguish from US corporates and consumers, you'll start to see retreats on some of these issues.
Yeah, it seemed to be a combination of bond market response and response from US retailers that seemed to change some thinking last time around. So we'll watch for that. Paul, thank you very much. Paul Donovan, Chief Economist at UBS Global Wealth Management, and Geoffrey Yu, Senior Macro Strategist at BNY. Coming up now, how does what we've heard about tariffs on Asia impact European companies? Trump's 36% tariff on goods from Thailand and Cambodia will impact on jewelers here in Europe. This and the other stocks that we're watching this morning. That's next. This is Bloomberg. Welcome back. 7:44 here in London. Tuesday, the 8th of July. The European equity market picture looks flat to positive, I'd say. The FTSE 100 perhaps going its own way. But elsewhere, we see a little bit of resilience in these markets. Waiting to hear perhaps in Europe a little more about what a US-Europe trade deal will look like. We have a little bit more time to play with, it would seem. It seems that those deadlines that were in place for tomorrow now pushed out to August 1st. So perhaps we have a little bit more time on that agenda. US futures are pointing slightly higher this morning. Joining us now, our Markets Live executive editor, Mark Cudmore. Mark, and I know that yesterday you were saying you were pretty positive for this week, for the near term around stocks. So were you surprised are you surprised at global stock resilience? I know US stocks fell yesterday into the close. But we have seen a sort of resilience through the Asia session. Is there anything about that surprises you?
I think even though I was bullish for this week, I was slightly surprised by how quickly Korean stocks really surged today. Japanese stocks held up. They thought they might be in the firing line in the short term. But I think the overall backdrop is kind of what we talked about yesterday, is the idea that the recent news flow has been exceptionally positive. We have this big fiscal tailwind, not just from the big, beautiful bill out of the US, but obviously NATO defense spending as well. We've had really good recent macro data out of the US and out of China as well. And generally, the data has held up quite well, much better than people were thinking even only 2 months ago. The consensus forecast for GDP growth around the world are getting raised again after falling into May because people are expecting that tariff damage to come through quicker. So I think that the overall short-term story is very good. And then the latest news flow, that the bigger picture on tariffs is that the deadline has been delayed again. And we've got, yes, prolonged uncertainty, but it's not this kind of sudden shock about to happen on Wednesday. So the short-term news flow is very good. Now, it's really important to emphasize, even though yesterday I was talking about being bullish, I was talking about bullish on Friday, I think that we get the short-term, we have higher levels to go in stocks, in US stocks, in global stocks. I do think that ultimately, tariffs are going to be very damaging for the US economy. They're going to be damaged for global economy. And I think the policy uncertainty is very poor for US companies. But I think it's a really slow moving story because there's so much uncertainty around it. So short term, remain positive on US stocks. Longer term, continue to think US stocks will suffer from high valuations and the fact that there's so much policy uncertainty that will continue to be ongoing and a higher cost of business.
Mark, I'm going to ask you kind of the same question we talked about yesterday. I was really surprised to see the U.S. dollar strength yesterday around these tariff announcements. What did you take away from that?
I think that was just a positioning squeeze in the short term. We had, that little bit of a shock of like, oh my God, we got really high levels again. I think some people have been betting that the new tariff levels might be massively reduced from April 2nd, and that wasn't clearly the case. So I think the short-term reaction was that the market, just cut back in some positioning, and they were short the dollar. So therefore, there's a little bit of a dollar squeeze. I think that, look, as you know, I very deeply believe that dollar depreciation has a lot further to go in the next couple of years. I think, short term, I'd still even favor a little bit of dollar downside. It's going to get more complicated because people are starting to trade the inflationary impact of tariffs, and you're starting to see higher yields, particularly US higher yields. So that's going to make it a little bit harder for the dollar downtrend from here. But longer term, absolutely, dollar is much more to decline.
Mark, FX has always been your crowning jewel in your brain. Talk to us a little bit about the ripple effect here. Jeff, you was just making the point that perhaps the tariff risk on Latin America is eliminating the appeal of the carry trade. What's your take?
I don't think so. I think the EM story is still overall very good. One of the main reasons I think that is because I have conviction in the dollar depreciation trend. And as the dollar falls, that it continues to increase the attractiveness of EM trades. It's an easing of financial conditions. It's an easing of an external debt. And simply, it improves the foreign currency returns of these investments, making the diversification trade more appealing over time. And that's a longer moving thing. I think short term, it does look like EM is in the firing line for Trump's ire and therefore the most focus of tariffs. But I think these will be dips that will be bought into investors as they continue to go back to these EM trades that were abandoned for so many years.
Fascinating dynamic playing out in the FX market. Bloomberg Markets Live executive editor Mark Cudmore joining the program this morning with his take. You can get more from him and the team. MLIV Go is the function on your terminal. Let's go from the macro to a little bit of the micro. Samsung's profits slumped last quarter for the first time since 2023, with a sharper than anticipated 56% drop in operating income. The results reflecting the deepening market share losses clouding the memory chip makers' prospects in the AI era. Combing through all the numbers is our very own Tom McKenzie. Tom, walk us through where this leaves South Korea when it comes to that AI race.
Yeah, and the biggest company in South Korea being Samsung, which makes, of course, everything from the TVs to the smartphones to the smartwatches. But they also, and this is what I want to draw your attention to, is the foundries business that they have as a contract manufacturer for chips, but also the producer of high bandwidth memory. And that is the AI play for Samsung. So let's focusing on those two units. The foundry business, they had to write down a whole load of inventory because of US export restrictions into the Chinese market. They take orders from Chinese clients to actually crunch out the chips in their foundries where they compete with TSMC. Because of those new restrictions, they've had to write down a lot of inventory when it comes to the foundries business. That's one part of the story. The high bandwidth memory, and this is where Samsung has lost its lead to its key rival SK Hynix. High bandwidth memory goes into the data centers alongside NVIDIA's AI accelerators and GPUs, and AMDs as well. But, of course, NVIDIA has 90% of the market share when it comes to GPUs. You need those high-bandwidth memory chips to go alongside the GPUs for those data centers to work. SK Hynix has stolen the lead because they've had the certification from NVIDIA, and Samsung has struggled to produce the kind of high-bandwidth memory chips that can get that accreditation and be put into the data centers. According to Bernstein, the market share for SK Hynix for high-bandwidth memory, 57%. For Samsung, it's just 27%. Morgan Stanley, though, putting out a note saying they see a bull case because Samsung is working on a new generation of high-bandwidth memory. If they get certification from NVIDIA, then there's a bull case there, according to Morgan Stanley.
So I suppose then, Tom, we watch European chip companies. I mean, they're all different. They all have different exposures to all kinds of different product, don't they? But just as a sentiment, sentiment could be affected, I suppose.
As a sentiment, there could be something of a read across. I think probably more likely from the export restrictions and the impact that that's had on the foundry part of the business. So those European names that still have exposure to still sell into the Chinese market, whether, of course, it's the maker of those lithography machines, ASML, different part of the market, but, of course, they face those export restrictions as well. We could be looking at potentially a little bit of softness there. Interesting, what you're seeing now is a debate in terms of the data center story. Jensen Huang was on the ground in Europe a few weeks ago saying you need to build more data centers. I've been speaking to the SAP CEO, the most valuable publicly listed company in Europe, Christian Klein. He says, no, you don't. We don't need data centers here because we don't have the demand, because we don't have the foundation models, the large language models that are actually training on those data centers. There's going to be no demand. That is a misallocation of capital, according to the CEO of SAP. So the debate around the infrastructure needs is continuing. We also spoke to the CEO of Grok. They make the chips that do the inferencing. So every time Anna gets onto OpenAI and asks a question, that answering the question, that's called inferencing.
Stop spying on my phone,
makes Tom. The chips. Lurking on your phone. Every time they use those, every time you ask a question, that's inferencing. Grok makes the inferencing chips. Higher speed, high efficiency, lower latency. they're making the case that that is where the focus is going to be beyond the training. We've got past the training of the models. The focus is going to be inferencing as we all use AI more. But that remains a debate.
Tom, thank you very much. Daybreak Europe anchor Tom McKenzie with a look at the numbers out of Samsung and some of the wider read across and the current debate in the chip sector. Now let's get to the stocks that we're watching this morning. Joe Easton has his eye on all that glitters right now.
I have indeed. Anything shiny, those shiny charm bracelets potentially in the eye of the storm today, given news on the Trump tariffs that we saw yesterday. Now, the US putting big tariffs on any products made in Southeast Asian countries like Cambodia, also Thailand. Now, Pandora, which is where we're going with the glittery thing into this segment there, they make 95% of their products in Thailand. So they're really in the eye of the storm when it comes to these tariffs. So that could potentially be a weak stock today. We saw Pandora dropping back in April when we got news of these big tariffs coming through, and these have now been confirmed. This is probably going to be a negative stock today. We're also going to be keeping our eye on the likes of Adidas and Puma as well. But in terms of Pandora, we have seen a rally in that stock over the past couple of years. Potentially it's going to be weak today alongside those clothing stocks that I mentioned there. Then in terms of the truck makers, we've got Daimler Truck doing a share buyback. Now this is potentially going to be supportive for the stock according to analysts at RBC, which says that this is an attractive valuation in terms of where the stock is. It's got a lot of cash, doing pretty well in the truck sales, and therefore they think could be positive this morning. That stock has recently started to show signs of some outperformance, so we'll see if that continues versus the other truck names. We might even see a bit of a read-through into Volvo and Traton as well. Keep an eye on Daimler Truck after that share buyback. Then finally, Glencore. We've got an overweight rating at JP Morgan. This is interesting because it's due to the M&A angle. So will Glencore look to spin off finally this coal business? JP Morgan thinks that they may well actually do this, and they think that if they do, there could be 20% upside in the stocks. They put an overweight or a buy on Glencore. That is a stock that has dipped down quite a lot, but JP Morgan reckons the coal spin-off could be positive, and they think you should buy Glencore. Keep an eye on that one in London today.
All right, Joe Easton from our equities team walking us through some of the potential stocks that are going to be moving at the open. When you look at the futures picture, though, Anna, not seeing a ton of action. I think maybe we were expecting a little more.
Some individual names could be active if they produce a lot of product over in Asia, and I'm seeing some companies being referenced like Pandora, also Doc Martens in that regard. We'll be back with the market open. That's coming up shortly. This is Bloomberg.
A few minutes ago until the opening trades across Europe. So how are we set up for today? We've got a lot of tariff news. We've got a lot of these ideas of letters, carve-outs, negotiations. All of that, when you look at these markets, haven't really made a dent in the European market yet. A lot of that news coming after the European markets closed. But we ended on yesterday's session on a high note, but you can really see perhaps the pain that was in the U.S. stock market. Is that a harbinger to come? This sell-off that you're seeing after Donald Trump's announcements, shaking the U.S. markets. Val, is it showing up yet in the European future story?
Look, Kriti, we have European futures quite resilient to that weak close on Wall Street yesterday. Eurostoxx 50 futures in the green, up 0.25%. Some underperformance in the FTSE 100 and some slight outperformance in the DAX, let's call it, up 0.25%. So it looks like futures are standing up pretty well ahead of Wall Street's close yesterday. What kind of stocks are we having our eye on today, Anna?
Yeah, let's have a look at a couple of sectors and some individual names that could be in focus. And of course, the big picture here is we have a little bit more clarity, another moving target when it comes to tariffs. So we have, in terms of the chip stocks, that's actually a story around Samsung. So we'll watch any read across into European chip makers on that Samsung story. It's interesting because this is about the contract chip making business, which isn't necessarily what European chip makers do, but they will watch for any read across there in terms of the sentiment. Some analysts saying that this outcome for Samsung is likely to be the bottom, so that also might play into the way that European markets respond to it. Apparel stocks in focus. If there are businesses in Europe that make a lot of product over in Asia, then could there be some read across into their ability to supply into the United States from those Asian production facilities? That's going to be a focus. And Daimler certainly in focus as well. Daimler Trucks announcing a buyback ahead of their capital markets day then. Kriti?
It's fascinating, Anna. We are, of course, counting down to the open, and it is a little bit of a muted story when you look at the futures picture. This is the opening trade across those European markets. Right out of the gates, the FTSE 100, anticlimactic open, I think, flat, basically, when it comes to what we're going to see. But do we see a little bit more shakeout when it comes to the DAX, for example? Going back to what that lazy trade is, this is a point that Val made on the future story. Do we start to see a little bit of outperformance there? Because that's what the markets do. When we don't have direction, you buy into the DAX, you stay flat on the FTSE 100. That's going to be something that we shake out, or see something that's going to be something that we see shake out. There we go. In the next couple of kind of moments. The IBEX, though, outperforming this morning, higher by about 0.3%. The CAC Iran higher as well. That is an interesting story, given the fact that there is a read-through when it comes to the tariffs imposed on the likes of Thailand, Cambodia, even China, Japan, South Korea. There should be a read-through, and yet we are not seeing that. Val, walk us through some of those early movers as we open these markets.
Well, if you take a look at the sectors at the top, we do have basic resources. I think that's all down to that Glencore upgrade from the street. The Glencore stock rising around 1.4%. So it is showing up in the best performing sector this morning. To the downside, we do have some consumer products down there. We are seeing Pandora move to the downside. That was something that we had our eye on earlier, down around 1%. But we're basically, it looks like 50-50 when it comes to the sectors. We got 9 in the green, 10 in the red so far this morning.
Yeah, I mean, we're getting optimistic soundings, aren't we, from Europe about what they're going to be able to achieve. And the last 24 hours have been dominated by, yes, news on tariffs, but also a shifting goalpost in terms of the day that this gets implemented. So I suppose all of that leaves us a little range bound, doesn't it, Valerie? So we are, yeah, as you say, 50-50. You mentioned basic resources. I'll mention travel and leisure. That's another sector that's not doing too badly. And there's a couple of different dynamics happening there. On the one hand, you've got oil prices coming down. And so that leaves space for the likes of TUI and IAG, Lufthansa, Ryanair to make small gains, really small actually, but still there is that direction of travel. And Entain, I'll just flag this one. This is a gaming business here in the UK, and that is up by nearly 4%. They've had an upgrade from one of the banks, so that's having an impact there. To the downside, Kriti, we've got real estate, personal consumer, discretionary and grocery stores.
Well, I bet a good chunk of that downside move was coming from Diageo. I'm just looking at some of those individual movers. Unilever as well. These are two major kind of consumer goods. Even Nestle, which is kind of a defensive bid as well. But immediately what caught my eye is the Diageo story. We know they're very exposed to the tariff threats. That, of course, specifically more to Latin America, which we haven't actually seen in the last 24 hours. But if we're talking about some sort of sentiment read-through, maybe that is one. We are, of course, to your point, Anna, you mentioned Glencore and Rio Tinto. In terms of commodity space, that's where we're seeing the bid. Is that the new kind of popular trade here, that you just kind of look at the macro assets and magnify that in the absence of any real moves? We were also looking for chip sectors as well. Not much of a read-through.
Yeah, we do have the technology sector as a whole in the green so far to start this trade. We do have, some red when it comes to those chip stocks, but they're down just marginally. ASML down 0.4%, ST Micro down 0.4%. So it does seem to be a limited read-through from those Samsung earnings that came in weak in the Asia session. Anna?
Yeah, I'll mention a few of the retailers because there could be some downside there if you're manufacturing, as we said, over in Asia and then trying to send that product to the United States. There are a limited number of European retailers that have the scale to be doing that kind of trade particularly, but there is a little bit of downside coming through on that sector. But yeah, no enormous moves. And US futures are actually pretty flat this morning as well.
I'm still surprised at the resilience of European equities. I mean, they closed at the highs yesterday, and they're adding to that today. They really seem resilient in the face of all these tariff headlines. I guess the market is really reflecting a more positive narrative about an EU-U.S. trade deal. 10% sounds like a good number. The market's taking it as a good number.
Is it resilient or is it the lazy trade? We keep asking our guests about that. What is the default? What is the go-to? The default for such a long time was when it's quiet, when there's less volume, light liquidity, everyone's taking their vacations this summer. You just get into NASDAQ futures and you call it a day. It feels like that new lazy trade, the complacent trade, is you buy into DAX and we call it a day.
Well, look, it's becoming a bit more clear. The EU isn't going to receive a letter with a 50% number on it or anything, higher than what was announced on April 2nd. So I think that reprieve we're seeing in the markets right now, you're seeing in the FX market, you're seeing it in the equity market.
And Europe has a little bit more time to talk then.
They do.
On Friday we were suggesting this August 1st date that's becoming increasingly used by the Trump administration. Maybe that'll leave more space for conversation, and then we hear confirmation from President Trump that he is open to talking over the next 3 weeks as we get towards August. And he has moved that tariff deadline for everybody, not just those countries that received letters. And maybe I should have made more of that at the top of the hour, because I think that is an interesting dynamic that we're following. So 4 minutes past 8, 4 minutes into our trading day here in Europe. European equity markets then pretty flat overall, pretty unmoved as a general rule. But let's have a look at the core six then and see where that takes us. We've touched on some of these names, I think, already a little bit. Novo Nordisk not moving anywhere. No big moves here. The biggest move coming from ASML. We were talking about some of that downside risk for technology, but maybe the read across is limited into that particular company. But that stock is down by 0.2%. Let's get a check on some of the individual stocks that are on the move. Joe Easton has a deeper dive for us. Joe.
A lot of these companies that are making goods over in Southeast Asia, so particularly Pandora. Remember, 95% of their jewellery made in Thailand. And we've seen that news over the weekend, or excuse me, over last night, we are still on Tuesday, that there is a tariff coming through on Thailand, 36%, that massive rate. So that is going to be a big weight on that company. And also Doc Martens, which is one that Anna flagged earlier. Now, they make a lot of their products in Laos, I believe that is the country that was flagged, and therefore that one down 4.5% almost at the moment. A little bit of weakness in Puma and Adidas. We saw some weakness in Lululemon last night in the US for a similar reason. Also, Nike was a little bit soft. So anyone that's making products in Southeast Asia, waking up to news of these big tariffs on those countries, and therefore a lot of red on that screen at the moment. One stock, though, was a little bit higher, was Daimler Truck over in Germany. A bit of a share buyback on that one. It was called a few percentage points high, but potentially a lot of the more negative themes of the market weighing on that one. So we're down or up 0.6%, trimming that gain from earlier, but doing a share buyback. Daimler Truck very slightly positive today. Then moving on to energy, a couple of stories out there. Equinor, that one was a little bit weak, slightly lower output on the latest quarter for the Norwegian company. So that is very slightly low, down 0.3% at the moment over in Oslo. But the other one I had my eye on was Galp. Now, this one over in Portugal, a bit of a renewable focus on that one as well. We'll see where that one is. Up 1.4%, a little bit better on that one. So Equinor going down, Galp going up in the energy stocks today. Then moving on to my favourite part of the morning, the rating changes. We've got Entain, another one of my favourite subjects, gambling. This one is upgraded today at Bank of America. It's not the area that I like to have a flutter in football. It is all the American sports. BetMGM continues to do well, according to Bank of America, and that's why they're moving the stock to buy today. I think Entain is a good one to be putting your money into, and that was actually at the top of the stock 600 at the open of trading. It's come down very slightly, but Entain gaining. Bank of America recommends buying. And then finally, just checking in on Glencore. We did flag that one earlier, and as we've already noted, it is a little bit higher. JP Morgan touting this one, going overweight. They think the company could finally spin off this big coal business. It's worth around $9 billion, and that could be positive, according to JPM. So they go overweight on Glencore. Glencore rising 1.6% in London this morning.
All right, Joe Easton from our equities team walking us through some of those early movers. We thank you so much. Coming up, we're going to connect a little bit of the dots of perhaps what this stock market is responding to and how it shows up in the commodity space. Donald Trump, of course, firing off a new wave of tariff threats. We're going to dive into that ripple effect. Francisco Blanch from Bank of America is going to be joining the program. Stick with us. This is Bloomberg. Welcome back to the opening trade. About 11 minutes into today's session, as we're seeing things shake out on the index level, there isn't much to look at, but seeing some bigger moves underneath the hood. How much of this, though, is really a question of the volatility, of caution, of complacency, or simply maybe a summer Tuesday? Joining us now for a look at the markets is Benedict Lowe, an equity derivative strategist for Europe at BNP Paribas Market 360. Make sense of this market for us, Benedict. I mean, how do you think about these markets when they're literally not moving while the tariff rate is?
Yeah, so first of all, it looks like the scenario for Europe is playing out quite positively. We haven't received the letter yet, and the discussions are still ongoing, and they're hoping to get a deal by Wednesday, which would be the best case for Europe. Now, when we look at what was priced into the market ahead of that, the market was basically expecting a move of slightly above 1% for the 5E. That is very low, but the reality is that positioning is a lot more lower in Europe than it was before the Liberation Day. And also there is this sense of fatigue overall, and we're seeing that throughout market overall in terms of headline news around tariff, with the market kind of pricing some negotiation down the way. So overall, we did not expect the same gamma move that we saw in April to happen this week.
Do you think, though, that we are going to see, elevated volatility levels around August 1st? Do you think that'll be the date that the market focuses on for this volatility to come?
Yeah, so we've got another extended deadline. It looks like it's going to be start of April. Before start of April, we've got a big CPI print that will be really focused in the US next week. So we've got a heavy calendar that will make it more important for the vol to play. But what I will mention is that the starting vol levels are not low in Europe. When you look at the 5-year 1-month vol, it's trading close to 16. So it's already somewhere priced in, not really at extended level, but there is a risk premium at the moment in European markets.
There's a risk premium. OK, so we could get some volatility before August, before we get that new deadline. Now, we've got earnings season between now and then. You mentioned the US CPI print, but also earnings season. You say in your notes, Benedict, that this is supposed to be a good earnings season. Where is that positive sentiment coming from? What's driving that positive outlook?
Well, there's a few things. First of all, I think the impact from tariff is less than what was feared at the previous earnings season. When we look at what happened at the previous earnings season, we were really in the midst of uncertainty. We didn't know what the tariff rate were going to be. We had some better level with some lower levels since then, so that is a positive. Now, the key thing for Europe, where there's a lot of uncertainty, is around the impact of FX. We've had a huge appreciation of the euro currency over the past quarter. That should be positive for US earnings, especially for the tech, which have a lot of revenue that is coming from non-dollar assets. But the headwind could come from Europe, from a higher currency level.
What is the risk? Talk to us about that kind of swing back, because the consensus trade right now is you short dollars, and you go long on the euro or arguably the pound even, or pick your currency. If that swings back, if you see a complete reallocation when it comes to the dollar and suddenly everyone is repositioning to, say, long dollar, for example, what kind of risk is there for European companies?
So that overall should be positive and should be a tailwind for European companies. We think there's been two main reasons why Europe has underperformed the US recently. The first one being some fears around the tariff deadline that we have this week. We saw yesterday a big outperformance of Europe over the US when that risk is starting to fade. The second one has been this big appreciation of the euro that is a headwind for European corporates. If that was to reverse, the bull case for European companies will be even stronger than we are at the moment.
But do you see this current level in Eurodollar as punitive for European equities? Because we've had various people come around and join us saying it's not yet there to that level, so it's going to hurt corporates or the European economy.
No, first of all, our FX strategists are expecting more appreciation of the Eurodollar. They have a target at 120, so they think there's more to come. Now, the reality is that we don't know how much FX hedge companies are. We don't know exactly in what currencies the contracts have been made, whether they were in euro terms, in dollar terms. So there's a lot of uncertainty, and I think this is why the analyst expectations around earnings for this year have been really stable recently. It's just because there's just a lot of uncertainty and people have been reluctant to change their expectation ahead of guidance from the companies on what the impact they expect to be.
Benedict, can I ask you about the read across from higher bond yields into stocks? Because we're seeing, Valerie was pointing out earlier to us that JGB yields were a little bit higher this morning. And, there's limited read across into Europe, but there is some. We see German yields up by 3 basis points at the 10-year horizon. I wonder how you're thinking about that link between yields and stocks in Europe at this point.
Yeah, so the key kind of thinking is that higher yields tends to be negative in terms of refinancing rate, in terms of valuations. Now, we're not at level yet in Europe that are too punitive for stocks. The question was more a US story with the level of yields that were much higher in the US. We saw the yields coming back down recently, so that was less of a question. So I think for now, if you stay around current levels, I think the bull case is more open for Europe, and rates levels should be less of a concern for European stocks.
Benedict, we are monitoring, I should say, very quickly, Ursula von der Leyen speaking in Parliament right now. Looks like she's making comments around China as well and potential security implications there. I want to bring this back to you and put this in a little bit of context. We're talking so much about U.S. tariff worries. When it comes to pricing in equity market risk, should we be looking to the east instead?
Yes, exactly. So I think there was this overall over-focus on what's happening with the US, and I think the focus is slowly shifting away from this. And we've had some negative news around announcement in China last week, and that could be definitely a risk for European stocks. We know that we are quite dependent also on the East. So that is one of the things we're monitoring and that we have on our radar.
How are you viewing the possible deflation effects in Europe? We had a guest on earlier who was talking about, the fact that if these tariff rates on the U.S. on importers to the U.S. go up, that increases the chance that there is some dumping of cheap goods in Europe. Is that something that maybe European corporates are worried about when it comes to their price competitiveness?
Yeah, I think there is this overall change in the dynamic of the trade structure overall, and that will be implication. I think the worry on the inflation level is first and foremost one of higher inflation in the U.S. What could that mean for U.S. market and what could be the implication for European market? I think the moment that is kind of the key focus for markets.
And that, in terms of volatility events, that's going to be something we watch, isn't it? Because we've got U.S., I think it's the middle of the month, we get the U.S. inflation print. So even before we get to August 1st, we've got to overcome that kind of hurdle. How would you expect markets to be approaching that news event, Bénédicte?
Yeah, so I think that print that we have next week in terms of the CPI in the US would be very key for markets. If we do have a more benign print, that could potentially open the door for that September cut to really be anchored in the market. And that would mean that it's a bull case for equities in the US if you start to price in more cuts coming for the US. Now, if we do get a higher print, that reopens or closes the door for that rate cuts to happen, that reopens the door for the Feds to remain on hold for the rest of the year. And that could be a disappointment for equities when you see that the rates market is still pricing in 2 cuts for the end of this year.
Well, Bénédicte, we've talked about the bond market, we've talked about the FX market. I think it's only natural to talk about the commodities market while we're at it. There's a big question here of whether we see some sort of commodity crash in the oil markets from major changes at OPEC policy, shale producers hedging, et cetera. If you do start to see that show up as lower inflation, how does that show up in the equity market?
Yeah, so we've seen the news around OPEC this weekend. Our economists do expect lower oil prices into year end. That is usually a net positive for European stock because European Union as a whole is dependent on oil. We're not exporter, we're a net importer. So what tends to happen is that when there's higher oil prices, Europe tends to underperform versus the US. Overall, apart from the sectorial divergence and dispersion, that should be net positive for European equities. Lower oil prices.
I guess final question on the outlook for European equities. Do you expect them to be outperforming or underperforming U.S. equities by the end of the year?
$1 million question. I think we are heading into the earnings season. The difficult bull case for Europe to outperform the U.S. over that time period is that there's going to be a massive tailwind for U.S. stocks coming from the lower dollar that we're not going to get. So I think once we get out of this earnings season, if the data is not too negative on Europe, then the bull case is reopening.
Right, earnings season is pivotal. Another guest coming on and telling us that this morning.
OK, Bénédicte, thank you very much. Bénédicte Lowe, equity derivative strategist for Europe at BNP Paribas Markets 360. Thank you very much for joining us, Bénédicte. Let's pivot from the equity story to what's happening in commodities. Kriti was talking there about whether we see this downward push in energy prices, what that might do to stocks. Well, let's focus in on the commodity side of things. This is the picture across a host of assets right now. You can see WTI down by 0.3%. Brent is down by 0.2% this morning. Let's get to Francisco Blanch, commodities and derivatives head at Bank of America Global Research, who's with us. Great to speak to you, Francisco. Thank you for joining us. We're, of course, dealing with a lot of tariff news flow, tariff headlines out of the US last night. The market overall, risk sentiment seems to be surviving this latest onslaught, seems quite resilient. What does this mean, big picture, for commodity markets?
Well, thanks for having me once again. So, look, I think commodity markets are certainly still vulnerable to tariff escalation. I think the trade war that started now, it's been probably almost 6 months ago, still moving commodity markets a lot. We've seen not just oil being impacted, but also copper, aluminum, of course, steel, which are at the heart of the tariff battle here. But the market is getting more used to it. And of course, one thing we've seen that is different to the first trade war during the first Trump administration is that we have a lot more stimulus going on. So we have the Chinese government pushing through enormous amounts of money into the economy. We also have the Europeans ramping up spending, particularly on defense, but also in other issues. And then, of course, we had the big, beautiful bill coming through the through the weekend, right? So there's a lot of money coming through, and this means the nominal economy will keep expanding. And in my mind, this could be a positive for commodity prices once we get through the trade tensions.
And Francisco, thinking about some of the things you cited there around fiscal spend and policy change and what that might do to the demand side. We heard from OPEC Plus, of course, as they increased production, that they were concerned about the demand side, the summer demand picture in particular, and that was one of the reasons that they had to increase production. Do you see that positive demand story evolving?
Well, I have to give credit to OPEC and particularly Prince Abdulaziz for reading the market, I think, probably better than most of people out there. We've had a lot of volumes added, at least via quotas. Of course, it's one thing to increase the quotas, a different thing to increase the volumes of production. These are two separate matters. So we haven't really had 1.6 million barrels a day, to be clear, added to the market. We've had less for now, but the market's still in backwardation. The front-end prices are higher than forward prices, which is creating an incentive, of course, for OPEC to bring more barrels. And then secondly, I think there's another issue, which is the differential between light oil and heavy oil, still very, very tight. And this means that refineries keep buying the marginal barrel that OPEC produces, which is Saudi heavy. So demand is robust. Demand is taking on the barrels. We've seen a strong diesel market this summer. Gasoline has been holding up, maybe a little less, but also seeing strong growth. So yeah, I mean, I think it's been a good time to add those barrels, and the market hasn't struggled for the time being to absorb it. Now, having said that, we are a little more negative into the second half of the year as we get closer to the shoulder season.
Well, Francisco, there's a question about where shale players come into this as well. You mentioned those demand and supply dynamics. In the last kind of price spike that we saw off of the war in Iran, there was a question of how many shale players hedged at those levels and are ultimately creating even more pressure to the downside. Francisco, how low can oil go?
Well, we are. Just to be clear, we are negative into the second half of the year. We think prices will fall into September, October. This is because we think there's going to be a surplus. We think there's going to be more supply, particularly given OPEC's latest quota increases, than there will be demand. And this means inventories will build, as they have, to be honest, in the first half of the year, and prices will fall. So that's our baseline scenario. We think that will happen to the range of 800, 900,000 barrels a day through the coming months. Now, having said that, remember, the first 6 months of the year, most of the inventories have built in China. And the majority of those inventories have built in China's strategic petroleum reserve. So inventories in Cushing are low. Inventories across Europe are low for crude oil. And inventories for petroleum products are also low. So we're going to have to see those inventory builds coming through before prices can come down to the levels that we target, which is probably in the, we think we'll go into the low 60s for Brent, and we'll probably hit again high 50s for WTI.
Francisco, just quickly, if you're a bit bearish on oil in the near term, what's your outlook for European natural gas, for LNG?
European natural gas, we think is going to be a tight market coming into the winter. We believe it will be hard to get to the 90% inventory target levels, 90% full inventory target levels that have been established by the European Commission. And part of it is that despite the fact that China's LNG demand is down 20% year on year, the world's still absorbing LNG at a pretty good pace, and Europe hasn't been able to build inventories.
Yeah.
It's very important that we build inventories. So we do think we'll be averaging probably roughly 40 euros per megawatt hour, maybe spike further. So it's going to be a tight market in our view.
Francisco, we have to leave the conversation there, but thank you so much for joining us. Francisco Blanch there from Bank of America. This is Bloomberg.
The
constant change of position and the delay of the date at which the tariffs are supposed to kick in, I think just confirms that a tariff war benefits no one. It is really a lose-lose proposition. And from the European Union, we have every interest in finding a good outcome that will continue to preserve free trade.
European Investment Bank President Nadia Calvino talking to us about what the actual reaction function is over at Europe when it comes to that tariff policy. Let's dive into that subject a little bit more. Bloomberg has learned that the EU is seeking to conclude a preliminary trade deal with the United States this week that would allow it to lock in a 10% tariff rate beyond an August 1st deadline. Now, member states are reportedly divided on how imbalanced a deal the bloc should accept. Joining us now is Arancha Gonzalez, Dean of the Paris School of International Affairs, who had previously served as the Executive Director of International Trade Center and as Minister of Foreign Affairs in the Spanish government of Pedro Sanchez. Quite the resume, the perfect person to join us this morning. Arancha, thank you again for your time. Walk us through that number, basically. I mean, we've seen a real turnaround when it comes to the European Union's disposition, going from 0 for 0 to maybe we'll accept 10. How much kind of appetite do you think there is for a rate, a level higher than 10%? How much do you think the EU would be willing to accept?
I think in Europe, the appetite for tariffs is pretty low. And it's pretty low because we know in Europe that tariffs don't help. They don't protect. They don't help you attract investment. If that is your goal, then you have to go and you have to look more at the structure of your own economy, at the factors that make for your competitiveness. Tariffs are just a tax that end up being paid by consumers. This is why the appetite in Europe is low. It's also the case that Europe prefers the route of a negotiation with the US. But Europe is also clear that it should not cave in to extortionary trade practices by the US administration. So there are the ingredients with which the European Union has to play to land this into somewhere that would be as little damaging as possible. That's what we're looking at. We're not looking at good stuff. We're looking at making this as least damaging a situation as possible.
Arancha, you have spent some time in the Spanish government. And I think the kind of tone that the Spanish government right now is really taking in the face of these tariff negotiations with Washington is perhaps revisiting the relationship between Europe and Beijing. And I think that one's something that I think you can give us a little bit more insight to. Is the answer to dealing with the tariff threat from Washington strengthening the relationship with Beijing instead? Where do you stand on that?
No, I don't think this is a fair description of what the EU is doing or what it should do. The EU needs to have a strong relationship with the US. It's its main trading partner. It's its security and defense ally. It's just that this is not the way this US administration looks at its relationship with Europe. On the other hand, China is a systemic country to the world economy. Is a very sizable part of world GDP, is 14% of international trade, is 30% of global emissions of CO2. So what Europe needs with China is to have a functional relationship. It's not replacing the US with China. It's not one or the other. It's the two, because the two are systemic and essential to the management of global economy, global emissions, and global stability, which is what Europe is looking for.
Arancha, you started off there by talking about how Europe has little appetite for tariffs, but they do protect some of their own industries with their own tariffs, be it agricultural goods, wine and spirits, even their car manufacturing is protected by tariffs. If they don't have any appetite for tariffs, why wouldn't they lower their own tariffs in order to get U.S. tariffs to zero as well?
Well, this is precisely what the European Union is doing as we speak. The EU is negotiating with countries around the world, is negotiating with India, is negotiating with the United Arab Emirates, with Thailand, is negotiating with Malaysia, with Australia, with the goal of reciprocally reducing tariffs, if possible, bringing them as close as possible to zero. Understanding that the tariffs that exist are the negotiating chip that Europe, as well as the other countries with whom the EU is negotiating. This is the negotiating chips they have, and this is how they will get to a good deal. But this is what the EU is doing. The European Union is not afraid of open markets. He's not afraid of negotiating with others. He's not afraid of competing in the world economy. It's just that it does not want to trade with other countries with a gun in its head. It does not appreciate extortionary trade policies, which is a bit what is at the moment facing with the current U.S. administration.
Is there any sectors there? We just had a graphic on screen showing that the pharmaceutical industry in Europe could be the most affected by tariffs. Is there any sector that you feel like is at least having some political persuasion, maybe telling the EU that tariffs could destroy the industry in Europe? Which ones do you see as the most vulnerable?
No, I mean, it's pretty clear, and it's also very telling, Valerie, what we're hearing from the CEOs of the pharmaceutical industry. They're basically saying it's not tariffs that will change pricing structure of medicines in the U.S., which is, at the end of the day, what the U.S. president has said is looking at. He's looking at reducing the price of medicines to U.S. consumers, and it's blaming the European Union for the high prices in the U.S. market. And we know that it's not European exports to the U.S. that is the reason for the prices in America. This is a factor of the policies that the U.S. has in place. So if the problem is one of prices of medicines in the U.S., it would be good to look at the structural policies in the U.S. But I would say, Valerie, pharmaceuticals is an important one. By the way, is a sector where both sides, the EU trades enormously with the EU and the EU trades enormously with the U.S. It's a clear example of win-win. Structural problems to the U.S. Pharmaceutical sector, for the healthcare sector, there are. Look at them and tackle them at home. Don't externalize the problems of the U.S. pharmaceutical sector.
OK, so we'll see if we get any movement on those sectoral tariffs. I know we haven't seen necessarily all of the details on that yet. Can I ask you about tech regulation, Arancha, and what we should be watching for there? Because the U.S. administration seems to want to factor the way that U.S. tech giants are treated abroad into a lot of the conversations right now. Scott Bessent, the Treasury Secretary, removed a clause within the Big Beautiful Bill when he said that the G7 moved on some of their tax policy around big tech. What should Europe be prepared to give up when it comes to tech?
Well, I think there is two parts to this discussion. One part is taxes. Another part is the regulations that are in place in Europe to protect citizens, to protect consumers, and to protect democracy from the abuse of technology, in particular in social networks or through social networks. And I don't think that this is an area that the European Union should trade with the US. I don't think the European Union should trade democracy, which is what a lot of these regulations are about, is protecting the ability of European democracy to work. So, I mean, on this one, on taxes, we've seen that there's been movements, although I have my own views on this one too. I would rather make taxation be fairer on both sides rather than give American companies a pass. But on regulatory frameworks that are to protect consumers, citizens, and democracy, I don't think the European Union should trade that.
Arancha, I know that obviously Brussels negotiates trade policy on behalf of the EU, but President Trump has liked to try to pick holes and pick apart the European Union on occasion, including quite recently flagging Spanish resistance to spending more money on defence. Do you think that that is going to possibly be negative for Spain when it comes to its relationship with the United States?
No, I don't think. First, it's pretty clear that this is the European Union Treaty. Trade is a community competence. No single European member state negotiates trade with third partners. It's done by the European Commission, and it's done on behalf of all EU member states. And, if you want an example, we've seen attempts by EU leaders to kind of be nicer, kinder more sympathetic to the US administration. But when the US has imposed tariffs, it's imposed them on all European Union member states, whether these member states were nice to the US or not. Tariffs on steel, tariffs on cars, and the 10% overall tariff have applied to all EU member states. So I think this is where the EU's strength is, in its unity, which is why I'm not too concerned about the US picking on one or two or three member states individually.
But Arancha, what message does that send? I mean, we know that Spain has now gotten this exemption from NATO, as Anna was just mentioning there. But what message does it send in terms of a unified approach from the EU, whether it comes to trade or whether it even comes to defense spending to NATO to defend European borders? If Spain gets the exemption, does that not create a roadmap for everyone else?
Well, what I would say is that it is important for all European Union member states, including Spain, to increase its security and defense spending. And Spain has just done that, is in the process of doing that because it needs a new budget to do that. But the signal that the government has sent is increase significantly spending on security and defense. Why? Because the international environment has darkened. It's more brutal today than it was in the past, and Europe needs a serious defense. But I would also say that in addition to spending more, what we need in Europe, and presumably this is what we are looking at NATO to do, is a clear deterrence posture. What we need is all members of NATO to clearly commit to defend other NATO members if ever there is an attack on them. And this is where we've had a bit of a question mark when the president of the US has put into question its commitment to the defense of the European continent. So yes, Europe needs to spend more. Yes, I'm convinced that Europe will do that, including Spain. But yes, what we also need is a clear deterrence posture. This is what Europe's enemies need to hear loud and clear. And if we are not clear on this one, we are weakening our ability to defend ourselves, and spending more cannot be a substitute for that clear deterrence posture that we need.
Well, Arancha, you're very clear on that deterrence posture, and you emphasize the fact that all of European countries, including Spain, need to be spending more. But there's more, and then there's 5%. There is a bigger gap between the 2.1% of GDP that Spain has committed to or gotten the exemption for relative to the 5% and the money and the kind of eating into the welfare budgets that every other country is enduring in favor of that defensive posture. My question to you here is, why are the numbers not the same? And is there some secret sauce here, ultimately, to getting to the same defense capabilities for less money? Does Spain have a solution that other European countries are not thinking about?
Well, I think on this, we have to listen very carefully also to what the International Monetary Fund is telling us. And what it is telling us is that we have to do this increase in spending, while at the same time making sure that we engage in fiscal paths that are sustainable. So to me, it's less about a magic number, and it's more about sending a clear signal and having a path where Europe does more on security and defense, spending more, but also spending better and also spending together. And we've made a lot of putting all of this into a number, which in my view may not necessarily capture the complexity of this conversation. So rather than looking at a number, I want to see a clear sense of direction in spending more, in spending better, and in spending together. That, in my view, together with a deterrence posture, is what will convince Europe's enemies that Europe is capable of defending itself.
Arancha Gonzalez, thank you very much for joining us. Dean of the Paris School of International Affairs, former foreign minister in Spain. Let us check, Val, what is going on the euro. Quite a lot of strength. Is this all trade related?
I mean, it could be around optimism about a 10% deal that we had reports of earlier, a 10% tariff deal, I should say, between the U.S. and the EU with some carve-outs leading to this positivity in the euro this morning. It's nearly unwinding all of yesterday's weakness. Remember, we had quite a bout of dollar strength yesterday. Our own Mark Cudmore from the MLIV blog was saying that was just a positioning squeeze, that the near-term low for the dollar isn't here yet, but we are seeing quite a reversal at the moment when it comes to euro-dollar strength, almost totally wiping out its weakness of yesterday.
Venram reminding us that at the beginning of the year, or actually the end of last, we were all talking about when we were going to get parity. Things look a little different right now.
A complete whirlwind in just 6 months' time to see this reversal. But that's the risk that we were just talking to Benedict Lowe as well, in terms of if you see a swing back in the other direction, how punitive is that for American companies, for European companies? What is the ripple effect? That's maybe something not people are thinking about.
Depends on when you've hedged, I guess.
Yeah, absolutely, as to whether how painful this is. OK, let us tell you what is coming up on the programme. Coming up, Emmanuel Macron is set to land in the UK for a state visit, mixing royal pageantry with some thorny political conversations. We will discuss what to expect from the French president's 3-day visit. Details next. This is Bloomberg.
Welcome back to the opening trade. We were 49 minutes into today's session. It's not a very exciting session, I will admit. The DAX is higher, though. It is the outperformer of the day, higher by about 0.2%. And I think that's all you need to know. I think we're waiting for a little bit of a rebound, a little bit more of a direction from those U.S. markets.
This market does no justice to the news flow, does it?
No, I was going to say, it's a summer Tuesday.
Well, let's take a look about some other potential catalysts for the market. We are light when it comes to economic data today, but plenty to watch when it comes to politics. Later, the French President Emmanuel Macron's first state visit to the UK will begin. We'll have more on that story in just a moment. Also, we have the EU economic and finance ministers meeting in Brussels. And later today, Amazon Prime Day begins. Their annual sales event begins through July 11th through Friday, with maybe some hints on how the U.S. consumer is shaping up. Anna.
I struggle. I have nothing interesting to say about shopping, but I'm sure many others will. Now, the French President Emmanuel Macron is due to arrive in the UK later this morning for the first state visit by a French leader since 2008. There'll be lots of pomp, lots of ceremony, but also plenty of really serious topics on the agenda. Let's get a briefing now. Bloomberg's Alex Morgan joins us on set with a look at what to expect. Alex, good morning. So what does the schedule look like? What's involved?
Well, it's a pretty packed 3-day schedule. I mean, I've said in the past I've got a busy few days. I think this is actually what a busy few days looks like. It is pretty intense. We actually can show you a little bit of what's to come. So the French president arriving with his wife today, greeted by the Prince and Princess of Wales at RAF Norfolk. That's a very senior royal welcome for the president before being conveyed to Windsor, not Buckingham Palace. Now, that's because there's renovations taking place here in London. There'll then be a welcome by the King before Macron will be back in London addressing parliamentarians, before heading back for a state banquet tonight. Wednesday, we move from the sort of pomp and the ceremony into sort of the political discussions, a bilateral meeting with the Prime Minister, Keir Starmer, before a banquet here in the city of London in the evening, if anyone's peckish and wants to pop over. Before Thursday, we're shifting more to look at defence with Starmer and Macron. In the morning, they'll be chairing or co-chairing the 37th Franco-British Summit, and then there's a meeting of the so-called Coalition of the Willing. You remember those nations pulled together when it looked like we might get a hasty end to the Ukraine war, which would require countries like the UK and France to step in and hold the peace. So a busy few days, ending on a joint presser from the two leaders on Thursday.
Alex, are we expecting any, I guess, serious discussions to lead to serious breakthroughs when it comes to defence and the migrant issue, which I know is on the agenda?
Yeah, I think, for me, I was looking at this and thinking about this. Really, it feels to me like a state visit of two flavours, if you like, of two sides. There's the hard edge of the UK soft power, which is deploying the King, the royal family, in a way that the UK really is quite unique in doing. The state visit emphasising the sort of post-Brexit thawing and a new entente cordiale between the UK and France. We know that's something Keir Starmer is very keen on. Migration, though, is quite literally and metaphorically a sort of a dividing channel between the two, the small boat crossings being a huge issue politically for Keir Starmer in the UK. Whether or not we'll get an inked deal on a new sort of returns framework from the UK and France, whereby migrants who make the crossing will be returned, we don't know. But when it comes to security and defence, of course, that's another shadow that's been cast right the way across these few days. But we also know that trade and investments are another part that the leaders want to be talking about. Thin on the details at this stage, but there'll be this bilateral meeting on Wednesday and then the Franco-British summit where maybe we'll tease out some more details. But the mood music very much is two countries trying to emphasise that Brexit, the B word, is behind us. There's an emphasis from these two leaders of moving forward, thawing things out, and I think trying to put on a good show despite some of these larger issues casting those shadows.
Yes, and coming a long way in terms of that bilateral relationship, Kriti, from the days when Liz Truss was Prime Minister and was asked if France was friend or foe, and she wasn't entirely sure she could answer the question, said that the jury was still out. So things have really changed a lot when it comes to these two countries.
It's a hard question. Bloomberg's Alex Morgan giving us the details of that state visit. We thank you so much. Let's stick with some of the UK news with a little bit of a corporate flavour if we can. Now, Schroders, a 221-year-old City of London financial institution, facing a pivotal moment. Speculation growing that the Schroder family, which still holds a 44% stake, might consider selling or breaking up the company. Leo Kenscherper is all over the story, our asset management reporter. Leo, what has gone wrong for Schroders?
Yes, thank you very much. So the challenges Schroders is facing are very similar to the challenges that other traditional active asset managers are facing. You know, when you look at their bread and butter mutual funds business, you can see that costs are rising and revenue is going down. And that's because investors switch to cheaper passive funds. Schroders also has a private markets business, which essentially consists of a lot of businesses that Schroders has acquired over the years, you know, a Swiss mid-market private equity firm, a renewable infrastructure manager. But on the whole, these businesses don't move the needle enough for Schroders. And the business has missed fundraising targets over the past years. And now what adds to the pressure for Schroders is that they're not entirely owned by the family. The family owns 44% and the rest is publicly listed. So the share price has now dropped more than 40% from its peak in 2021, and you can really see that investors' patience is wearing really thin.
It's not the first time that the Schroder family has felt under pressure in this sense, Leo. What's the backstory here?
Yeah, so the parallels are really striking. In the 1990s, a lot of UK investment or merchant banks, you know, the likes of SG Warburg, Kleinwood Benson, they have decided to sell because essentially Wall Street giants were increasingly eating their lunch. They had bigger balance sheets and were winning more and more business as a result. And Bruno Schroder, the dominant figure at Schroders for decades, also decided to sell to Citi for £1.3 billion. And that move really served them well, I have to say. They sold during a boom time for investment banking, and they avoided, of course, the worst of the great financial crisis. So yeah, that turned out to be a really good call. And now, 25 years later, you've got giants, asset management giants, also from the US, coming for Schroders on both sides of the fee spectrum. You've got passive giants like BlackRock, who have taken in, I think, nearly as much net new client money over the past 2 years as Schroders has in total. And of course, you've got Blackstone, private market giants, who are also winning more and more market share. So many people in the city are wondering if, you know, history is repeating itself.
All right, Bloomberg's Leo Kenscherper walking us through history potentially repeating itself. We thank you so much walking us through the Schroeder story. It's fascinating. We've got a lot to digest in terms of today's trading day, what could come ahead. A lot of the focus, at least in the UK, while these markets aren't really reacting, seems to be the state visit from Macron, what's going on in the banking industry. I wonder if that changes in a couple hours' time.
Yeah, I mean, we've got markets pretty quiet, aren't they, dealing with this change of date, this moving goalpost. And, you know, I came into this morning thinking, or last night thinking, we've got to hear from Europe because that deadline still applies. And actually, that deadline has for all trading partners has been moved to August the 1st. And so that's not the case. And so when we hear from Europe, again, another moving feast, waiting to get some kind of confirmation on them being able to achieve a 10% tariff, which compared to lots of other countries would be seen as a win, perhaps.
Yeah, no, you can say that European stocks aren't really moving today, but they did close at the highs, even with Wall Street declining into the close. So they're doing pretty well today. Same with Eurodollar as well.
They have moved. Coming up, the Robinhood CEO joins the Pulse. Don't miss that interview. That's in just over half an hour's time. This is Bloomberg.